RRSPs and retirement savings can be quite confusing. In this video, I'm going to give you 5 tips and tricks to better understand RRSPs, how they work, and how to use them to your advantage for your retirement savings. Number 1 is the deadline. So for 2020 tax season, the RRSP deadline is March 1st, 2021. So any RRSP contribution that you want to make to use for your 2020 taxes, you need to make sure it's contributed to your RRSP by March 1st. Now, March 1st falls on a Monday this year, so don't leave it till last minute. Maybe try and get it in the week before. Number 2 is your contribution limit. So your contribution limit every year is 18% of your earned income. Every year, this has a maximum. In 2020, the maximum was $27,230. So if 18% of your income is more than $27,230, you will be capped at that limit. Your contribution limit also includes carryover from previous years. So if you haven't contributed the maximum amount to your RRSP or to a pension plan in previous years, you may have a carryover, which you can find on your notice of assessment. Number 3 is if you have a pension plan at work. This could be a defined benefit, a defined contribution, or a profit sharing plan. Any contributions through those pension sources will decrease and affect your RRSP contribution limit. So make sure you're aware of those pension adjustments before you max out your RRSPs. If you're not sure if you have a pension adjustment, on your T4 slip, it'll be in box 52. And on your T4A, it'll be in box 34. So number 4 is how you can use and when you can use your RRSP deduction. So if you make a contribution to an RRSP, you can deduct it if you make it before March 1st for 2020. But if you don't need the tax deduction for 2020, you can carry it forward to 2021 or a future year. So because you make an RRSP contribution now, doesn't mean that you have to use the deduction now. One reason you may want to carry forward your deduction is because you plan to have an increase in your income. If you know that your income is going to increase over the next few years, it may be worth it to use that deduction in future years to get a larger tax break. If you think you fall into this category, make sure you talk to your tax professional or financial planner to create a strategy that's going to be best for you. The 5th tip and trick that we want to share with you is over contribution. So there's 2 sides of this coin. You can over contribute $2,000 to an RRSP in your lifetime without any fees or penalties. When you go above $2,000 over contribution, the penalty is 1% every month. So it's very punitive. So make sure you don't over contribute to your RRSP. Going back to the benefit of an over contribution. If you're in a high tax bracket, high income, and you know that your income is going to drop off maybe for good, maybe you're retiring, it may be worth it to use that $2,000 over contribution to get the tax deduction and not have to pay any fees. So we have a client we're working with right now. He's retiring in 2021 now. So we're going to max out and over contribute $2,000 to his RRSP for 2020 to get a maximum tax break. For him, it's 40% tax back. So he's going to get $800 refund, no penalty on that over contribution. And that's something he wouldn't have been able to use going forward. So our bonus tip today is to reinvest your refund. So when you make a contribution to an RRSP, if you paid the right amount of tax throughout the year, you should receive a tax refund. So what do you do with this tax refund? Most of our clients and most Canadians will take it and use it for travel or paying bills or whatever it may be. So if you have a high interest debt, that's a great place to put it. But if you don't have a plan for that money, let's invest it. Let's save it for retirement. So a quick example, let's say you're 45 years old and your tax refund is $2,000 a year until 65 when you retire. If you were to take that money and invest it just at 5%, at 65, you would have a bucket of over $66,000. And that could equate to about $8,500 each year for the first 10 years of retirement to travel with. So your $2,000 tax refund every year, you could turn into an $8,500 vacation for the first 10 years of retirement. So instead of using that small amount of money now, save it up, use compound interest to your benefit, and let's take some better travel experiences in retirement. Thanks for joining us today. Make sure you subscribe to the channel, and if you enjoyed the video, hit a thumbs up. It really does help our videos get out to more people, more Canadians, to learn more good content on how to save for retirement.